This is Bloomberg Wall Street Week.
The global push into infrastructure, breaking the IPO logjam in tech.
The financial stories that shape our world.
Cutting inflation without losing jobs. Do we need rate cuts? And if so, how many? Investing in a time of geopolitical turmoil.
Through the eyes of the most influential voices.
Ken Rogoff, economist of Harvard. Former FDIC head Sheila Bair. GE CEO Larry Culp. San Francisco Fed President Mary Daly.
Bloomberg Wall Street Week with David Westin from Bloomberg Radio.
Europe takes a right turn, Sherry Redstone takes a pass, and the Fed just takes it slow. This is Bloomberg Wall Street Week. I'm David Westin. This week, Bloomberg's Stephanie Flanders on what happened to Europe.
There was a particular humbling of the sort of centre and the established parties.
Ruchir Sharma of Rockefeller International on what happened to capitalism.
Every time we have a crisis, the bailouts get bigger.
And Ron Olson of Munger, Tolles & Olson on his half-century at the side of Warren Buffett and Charlie Munger.
Neither Warren nor Charlie are typical.
And we start with the backward-looking economic numbers of the United States this week and the forward-looking statement of economic projections from the Fed and what the chair, Jay Powell, had to say about it. And we welcome back our very special contributor. He's Larry Summers of Harvard. So, Larry, great to have you with us. What did you make out of, we had some encouraging numbers, actually, on inflation. At the same time, the Fed is a little reluctant to talk too quickly about cutting.
The numbers were encouraging. It's 1 month, but, every month is data, and I think the right posture has to be agnosticism about where we are going forward. It's hard to interpret the Fed's forecasts because they probably had a lot of inertia with everybody having set their view coming into the meeting. So it's not really clear that the projections that people were making genuinely reflected the new numbers. That was a point that Chairman Powell stressed.
We also have fiscal policy issues coming up that in a sense are on the ballot come November. There's increasing discussion about the alternatives between Joe Biden and Donald Trump with respect to fiscal policy. And you've been outspoken on the question, as others have been, about the possibility of inflation with the Trump economic policy. Take us through that.
Look, I don't think there's been a more inflationary presidential economic policy platform in my lifetime. Perhaps George McGovern in 1972 in some ways would be a comparison. But other than that, I don't think there's been remotely comparably irresponsible set of proposals. His tariff proposals are the biggest supply shock, pushing up prices, not just of imported goods, but of all the goods that compete with imported goods. That anybody who's worried about gouging should think that more competition, including from abroad, is a very, very important step. And he's for much greater restrictions on the supply of labor, leading to more wage inflation pressures. And he's for scaling back the subsidies to renewable energy, raising energy costs. So look at it from demand, look at it from supply. This is a prescription for a major increase in inflation. And of course, the expectation of that major increase in inflation, and possibly the fact that the Fed will be under much more pressure to prove that it's credible, this could easily be a prescription for a 10% mortgage rate, something that I lived through when I bought my first house, but that I didn't think we were going to see again in the United States. This is really dangerous stuff.
Larry, let me pick up on the tariffs issue specifically. As we know, former President Trump traveled to Capitol Hill this week, and there were reports in the press that he floated, at least as an idea, replacing some or all wall of income tax with tariffs. There was one report that actually would just replace it entirely. What would that do from an macroeconomic point of view?
Look, people misspeak. Sometimes they're not serious about the things they say. That's probably a feature of candidate Trump. But replacing the income tax with revenue with tariff would be the worst macroeconomic policy proposal in U.S. history. It, of course, burdens the middle class and the poor who purchase goods that exist on international markets. So it's regressive, as many economic commentators have suggested. But that is actually the least of it. Think about it this way. The Smoot-Hawley tariffs, which did enormous damage, some people would say made the Depression great, were 0.6% of GDP. If you replaced half of income tax revenues, not all like he talked about, if you replaced half of income tax revenues with tariffs, those would be tariffs 6 times Smoot-Hawley levels. That's got the potential to do enormous damage to the competitiveness of every U.S. exporter, to do huge damage to all kinds of workers who use imported goods in what their businesses produce, to create a downward spiral as much higher prices for everything we import means consumers have less to spend on everything else, create worldwide economic warfare as the rest of the world responds. This is a prescription for the mother of all stagflations. Now, I don't think it's likely to happen, even if President Trump is elected, so I don't know that markets should be discounting all of that, but this is something that I think should be viewed very ominously.
Okay, Larry, thank you so very much for being with us. That's Larry Summers of Harvard, our very special contributor here on Wall Street Week. Sunday's elections for the European Parliament delivered a surprise setback for incumbents in France and Germany, even leading French President Macron to call a snap parliamentary election in France next month. And markets have reacted accordingly. To explain the situation and what's likely to come next, we welcome back Bloomberg Senior Executive Editor for Economics and Government, Stephanie Flanders. So, Stephanie, not only does your job require this, but you also have a podcast called Votonomics, where you talk about economics butting up against politics. We certainly see that in Europe right now. We see a lot of movement in the French market particularly, but I guess it was really triggered by these European parliamentary elections.
Yeah, and you have the European parliamentary elections, which, as you'll remember, it's elections for the European Parliament, which controls some parts of European policy, not all parts of European policy. And the sort of headline sounds uninteresting in the sense that the sort of centre grouping that's led by, represented by Ursula von der Leyen, the current European Commission president, did still emerge as the largest grouping. It got about 60% of the votes. But as expected, you did have quite a lot of success. About a quarter of the votes went to far-right parties. And as you say, there was a particular humbling of the sort of centre and the established parties in France and Germany. Olaf Scholz's Socialist Party was completely hammered by the Alternative for Deutschland and other parties in Germany. And you had the rise of Rassemblement National, used to be the National Front, the far-right party in France.
So let's turn to France for a moment, because that was an immediate aftermath of this, as we saw President Macron, I think, surprise maybe even his own party and say, let's have a snap election right away here. At the same time, there's a real resurgence of the right of center, maybe well right of center, of Marine Le Pen and her party. What could that mean, this election, in terms of the French economy?
It's extraordinary. I mean, we had at the start of a few weeks ago, we had the surprise decision by Rishi Sunak to call an election, but he did have to kind of call one in the next 9 months, and we were just surprised that he was doing it sooner. In Macron's case, I mean, he surprised people in his own office, as far as we can see. He held it very close, that decision. He's kind of got a reputation in the past for having taken enormous risks. He took an enormous risk in running for president without an established party all those years ago. So you can see this is kind of part of his MO, but it has left open a wide range of outcomes.
And the one really source of stability, ironically, appears to be Italy. And Ms. Meloni, who came out of these elections rather well. There was a time not that long ago where we thought she was sort of an extreme, but now she's seeming a reasonable centrist.
Yeah, I mean, it's very interesting, isn't it? And we are going to see her the end of this week. We've had her leading hosting the G7 summit in Puglia, which is not a bad place to have it this time of year, and very amicable, considered to be a very credible leader in Europe, has very much been normalized and become the acceptable face of the far right in Europe. She's got some problems percolating under the surface. The Italian debt, always an issue, is becoming more of an issue. It's now on a more unsustainable path and has already, in fact, is violating the European Union's rules on how much you can borrow. So she's going to be having a tussle with them about how much she has to tighten policy, and that could make her more politically unpopular in Italy. But it is interesting. You see the likes of Marine Le Pen in France, who has a very odd mixture of economic policies, quite far left policies that I think investors would be concerned about. Many people are saying the best path for her, if she would be the sort of Meloni path of actually building credibility with the markets and being mainstream in economic ways, even as you are being quite far right, or certainly culturally right, on immigration and other things. So that's another interest. It doesn't look like Marine Le Pen's really going to be able to pull off the same trick that Giorgia Meloni's pulled off.
Stephanie, thank you so much. Always great to have you with us. That is Bloomberg's own. She's Stephanie Flanders. Coming up, we look at where the Indian economy heads next as Prime Minister Modi begins his third term with Ruchir Sharma of Rockefeller International.
Even though Modi won, it is seen by many people as some sort of a moral defeat.
That's next on Wall Street Week on Bloomberg.
This is Bloomberg Wall Street Week with David Westin from Bloomberg Radio.
This is Wall Street Week. I'm David Westin. Prime Minister Modi has begun his third term after an election that did not give his party the clear majority many had expected. To take us through what we should expect next, welcome back now Ruchir Sharma. He's chairman of Rockefeller International and author of the new book, What Went Wrong With Capitalism. Welcome back, Ruchir.
Thanks, David.
So we're going to talk about your new book. Before that, let's just spend a minute or two on India, because we talked about it before. You were one of the first ones that I saw who suggested maybe it wouldn't be a landslide for Modi. What are the possible consequences, do you think, for economic policy of what we've seen?
Well, I think that the way the election result has been interpreted is that in some ways it's seen as if this is a two-speed economy going on in India, that the urban consumer is in good health and almost booming, but the rural economy in India, in many parts at least, is in some sort of distress. So I suspect that there'll be some shift in terms of the spending priorities of the government in favor more of the rural economy and trying to do something a bit more about that. But I'd say the big takeaway of this election, and I think that this is something which I think has been really underappreciated, that if you look at elections around the world, and particularly if you look at even India's electoral history, after an election, it is usually viewed as a mandate for something. And at the same time, the opposition, at least for a while, goes into retreat. Because they've just lost an election, they go into retreat and try and regroup. What's very unique about this Indian election is that even though Modi won, it is seen by many people as some sort of a moral defeat, just because the benchmark was so high and he's ended up with seats which are well short of the majority mark just for his own party. On the other hand, the opposition is already behaving as if it won. it's been emboldened, it's out there, much more aggressive, and a lot of the post-poll analysis is why did the opposition do so well? So this is a very strange election that way, that it's not been a cleansing or a catharsis in some way. It's been like, in terms of the consequences are going to be that the opposition from day one is going to be emboldened, and I dare say almost disruptive. So I don't see that much policy action take place in India given this verdict.
You mentioned urban versus rural. What about socioeconomic distinctions? Because there have been some reports I've seen that, in fact, one of the things that turned on Prime Minister Modi was the fact that the lower income people felt that they'd been left behind.
Yeah, but I think there are many stories in India, because what is true in one state is not true in another state. And I think that's the part about India which we have spoken about, and something which I think is not fully understood by many people, that what happened in this election also is that there was no wave. There was no wave for Modi. Instead, we ended up in the traditional India where every state had its own contest in many ways, and so therefore you got an outcome which was an aggregation of what the various states were doing. And you're right, there was some feeling in some states, which even I traveled to, such as Maharashtra, where a lot of people felt that they were not getting the benefits of what was being promised, and they were facing some sort of local issues. So that's true in terms of socioeconomic divide, and yes, more of the poor, it seems, did vote, and more of the so-called, what they call in India, the backward caste, they voted for the opposition parties rather than Modi. So that's true, but it's a much more nuanced story. But the broad takeaway, as I said, is that I expect very little to get done in terms of new policies over the next year from an economic perspective.
One of the things we've talked about in the past was the growth policies of Prime Minister Modi, combined with relative restraint on inflation, being able to really contain that. Is it likely that in order to reach out to some of the people that he did not bring along with him, Prime Minister Modi will be driven to drive higher inflation through more stimulus?
I hope not, because I feel that if there's one relative success story that the government had over the last 5 to 10 years, it was on keeping inflation relatively low. Now, of course, in India's case, whenever you go out and talk to people, they will always tell you that rising prices is an issue, because in India's case, so many people are living at the margin, they can't afford any increase in prices. But generally in India's case, the inflation performance was much better. In fact, the big problem with the previous government was that they let inflation get out of control. So I think if he has any sort of, sensitivity to what people want, and I think this is true everywhere. We're seeing it in the US as well, that we don't know whether good economic growth gets you re-elected, but we do know for sure that if you end up with high inflation, that gets you into big trouble. And even the US, which we'll speak about, the high inflation rates of the last 3 to 4 years are a real problem for the Biden administration.
Congratulations, Ruchir, another book out. So let's talk about exactly the thesis of this book, because it is a statement, not a question about what went wrong. So what has gone wrong? How do you know it's gone wrong?
When I look at the poll numbers, for example, that on one hand you have all this great data that the American economy is relatively resilient, but if you look at the number of people who are happy in America with the state of the economic union, it is at close to record lows according to many polls. There are about 7 in 10 Americans today who want the major change to the economic system, or in the language of the polls, have it completely toned down. That's pretty dramatic. There are only about 35% or so Americans today who feel that they're going to be better off than their parents. 50, 60 years ago, about 70, 80% of Americans felt that they're going to be better off than their parents. So there's a real feeling that something has gone wrong. And I think that it's particularly the fact to do with capitalism, that most young Democrats, in particular in America today, say they would rather have socialism than have capitalism. Now that's such a big statement for this beacon of American capitalism and all that we've spoken about, of global capitalism rather. They are saying that they would rather have socialism, a large cohort of the millennials and the young people, rather than have capitalism. So something has gone wrong, and what I've done in this book is to sort of look at deep down what's gone wrong? Because, as they say, the first step to a cure is to first diagnose the problem. But I feel that in America today, we're not even diagnosing what the underlying problem is.
Why does it make sense from your point of view, having studied this now, if you didn't know anything about our society, if you didn't read any of the media, you didn't read any of the polls, and you looked at our growth rate, which is at or above historical trend lines, and you looked at unemployment, which is close to lows of all time, most indications would say this should be a pretty happy economy. So why is it not?
Exactly. So, because after I said that there's a sliver at the top which is doing very well, but we have this two-track economy out here that even now, if you look at it, the bottom 50 to 60%, they don't have any excess savings. They're not being able to spend that much. And as I said, that there's a feeling that they're being squashed by what's happening at the top. That today in America, economic mobility, social mobility, all have declined significantly. Like, this is a country where people would move around a lot, or people would be in search of an opportunity. As I said, there's a real feeling in America today that they don't have equality of opportunity.
Is it the government's fault in this sense? 2008, 2009, we had the great financial crisis. There was concern about a depression, not just a great recession, but a depression. And there was a lot of government intervention, both on the monetary side and the fiscal side. A lot of people thought that was necessary to save us and maybe the world from depression. Then you had a pandemic. We brought the economy to a stop. And again, it was thought there needed to be a lot of stimulus. Was it the government's fault? Didn't they need to come in and have this level of stimulus and support?
Yeah, as I say in the book, that when we have a crisis, I can understand that the government needs to intervene. I'm not a kind of person who's a liquidationist, that you just let things sort of go and melt away on its own. What I've shown in the book is just look at the progression of capitalism over the last 100 years. We have gone from this liquidationist argument, which caused the Great Depression in the 1930s, to now an impulse where you liquefy. That the moment you have even the slightest crisis, like you had last year with the SVB or some, the impulse is that we got to intervene, we got to save. And the problem is that we only have one case point, which is what we use all the time to justify intervention, which is that we think if we don't intervene, we'll have another Great Depression. That is the argument used all the time. But what's the result today? The result today is the fact that bankruptcies are close to a record low. We have the number of new startups instead which have been coming up right about until the pandemic, have been declining. So if you keep so much deadwood alive, and you keep so many incumbents and entrenched billionaires and oligopolies alive, you're not allowing new things to really surface. And the middle, in particular, is getting squeezed. So the argument in the book is that you're right, that when we have a crisis, you need some government help. But this is not just about crisis. This is about every time there's a minor flutter, you end up getting government intervention. And it's not just about government spending, as I said. Look at the amount of regulations. Every year, like in America, we introduce 3,000 new regulations. How many regulations have we withdrawn over the last 20 years? 20 in total, right? So we got a regulatory state, a bailout nation that in America in the 60s and 70s and all, bailing out a private sector company in America was considered heretical. We at America, we don't do this. Then you begin with the 1984 first big financial institution bailout in terms of continental Illinois. And after that, progressively, every time we have a crisis, the bailouts get bigger. And so that's again sort of, leaves a feeling with people that are we really a bailout nation? And if these, rich corporates are getting bailed out, the average person thinks, why am I not getting more out of this? So it's about regulation. It's about bailouts. It's about government spending, which has gone up from 3% of GDP 100 years ago to 36% of GDP today. Through every administration, we almost, regarding some air pockets here, there, or the other, we have seen an increase in government spending.
Every administration, including Reagan, because people tend to think of Ronald Reagan as being a smaller government philosophy.
Yeah, but the facts just don't bear it out, because under his administration, government spending increases slowed down a bit, but they kept on sort of, carrying on at pretty high levels. And then if you look at in terms of what happened under him as far as regulations were concerned, even though under Reagan too, those kept on going up. The only deregulation we saw was the financial sector. The financial sector saw lots of deregulation, but outside of that, for the small and medium-sized businesses, the regulatory burden has kept getting bigger. And this has real consequences, David, because it means that if you're looking to start a new business, the cost of doing that today is way higher on Wall Street, where, for example, if you're looking to start a fund today, it's 10 times in terms of the cost compared to 20 years ago. So, that just means that if you're already in business or if you're a big person in business, you're able to benefit. So capitalism today in its distorted form has become pro-incumbent and it has become pro-big business, whereas in its true form, capitalism should be pro-competition and pro-churn.
The book is What Went Wrong with Capitalism, and the author is Ruchir Sharma of Rockefeller International. Coming up, the unique partnership of Warren Buffett and Charlie Munger through the eyes of their lawyer for over 50 years, Ron Olson of Munger, Tolles & Olson.
I know no partnerships that have lasted as long as the two of them had.
That's next on Wall Street Week on Bloomberg.
This is Bloomberg Wall Street Week with David Westin from Bloomberg Radio.
This is Wall Street Week. I'm David Westin. Warren Buffett or Charlie Munger would have been historic investors individually if they'd never met one another. But they did meet and formed a partnership for over 50 years, one which their lawyer, Ron Olson of Munger, Tolles & Olson, observed from close up almost since it began. We talked with Ron about that partnership, what made it work, and what made it different.
Neither Warren nor Charlie are typical. Did they have problems that were similar? Yes, but Warren and Charlie had the owner's attitude from day one and took a deep, deep interest in any problem. They did their own homework. They didn't believe in consultants. They didn't believe in figuring out compensation for the managers with a compensation consultant. They operated independent of Wall Street. So they were very different than most other clients, I would say. And the fact that they owned the problem, they each had a deep understanding of every problem I got into. Maybe the first one that was significant was when they acquired the Buffalo Evening News. And within a few days thereafter, the competitive newspaper, the Courier Express, filed an antitrust case with a rather loudmouth plaintiff's attorney from San Francisco that I knew well and had a lot of fun with, actually, Fred Firth. And so I spent a good part of that winter on that case. And Warren, of course, was deeply interested in it, as was Charlie. He claimed that the process that was being used by, really Warren developed, to introduce the Buffalo Evening News as a competitive morning paper as opposed to an afternoon paper was monopolization. Judge Briand in the trial court wrote a lengthy opinion against us and basically made the point that Berkshire had not complied with the rules of Marquis and Queensberry. And Henry Friendly, in his opinion, said, I've searched the antitrust laws up and down, and I couldn't find that rule of the Marquis of Queensberry. But at any rate, Warren and I got to know each other, and of course many others since. I would say that we were in the trenches the longest in the Solomon problem, and thereafter, you build a relationship that always goes beyond the problem.
Ron, talk to us about risk. I mean, risk is at the center of investment decisions. And it's also an important part of what a lawyer does, is assess risk and apprise clients of that risk. How does Warren Buffett approach risk in your experience as his lawyer?
Well, carefully. And he approaches it also often with Charlie. I mean, they would talk regularly, and particularly if you're talking about risk associated with an investment, that was a regular occurrence. And each of them approach that, I think, somewhat differently. They have a different set of priorities, a different set of readings, a different set of life experiences. Warren is, as you know, very gregarious, out front. He's the one who cuts the deals. Charlie's still sitting in his chair, as his kids say. He looks like a book with two legs, reading every day. No, the two of them had this unique partnership. And that's another reason I don't have a lot of clients with a unique partnership like that. There's complete trust. There was a grounding in, I would say, Midwestern values. Warren had, and Charlie too, both had big developed accounting capabilities. They both read all the financials, knew them well, but they didn't buy companies without an established record of consistent profits for 5 years or more, a leadership that they trusted with that had integrity and had run the companies that they were about to acquire. And one question Warren always asked was, is this person going to love the money more than he loves the business? Because Berkshire is about to make them very rich. And if they did, it wasn't a deal. If they loved the business more, that's who we want. And so it was a combination of risk assessment, but as I say, I think Charlie added a perspective that, and he was guided. He read every great psychologist and knew all the biases that exist in judgment, and the enthusiasm of deal was more evident in Warren, but confirmation bias was something Charlie guarded against in everything he did. And those are some of the thoughts.
Having watched this partnership for over 50 years, as you say, from a pretty close distance, actually, what caused it to sustain?
Just to be clear, Charlie joined the board in 1975, but the partnership of the two of them, informal and then later very much a part of Berkshire Hathaway, existed, yes.
So that partnership, what sustained it? Because we have seen other partnerships that are based on mutual trust and different contributions of the two partners, and that have been close partnerships, but they don't tend to last for over 50 years.
Well, I would say a couple of things. I mentioned the common backgrounds. They both had IQs that are off the chart. They both respected that. They both had memories that exceeded mine, and they respected that. They both were interested in building a company that would have permanence and committed themselves to it, particularly when Warren went along with Charlie finally and moved from buying what were referred to as cigarette companies with a few puffs left at a cheap price, and Charlie convinced them that it's far better for permanence to buy wonderful companies at a fair price than fair companies at a wonderful price. And they were dedicated to that. They were, and as Warren said in his tribute to Charlie in the annual letter, he let him take the bows. And he also noted in the letter that after he had blundered and made a mistake on something, Charlie never reminded him of it. And that Charlie was to Warren very much like the combination of a brother and a father.
You talk about permanence and the fact that Warren and Charlie wanted something that was permanent. Unfortunately, in human institutions, nothing's permanent. We've lost Charlie Munger, sadly. Warren has no inclination and fears of going anywhere. At the same time, there will come a time when he's no longer with us. Have they succeeded, you think, in setting up something that can be permanent, that can outlast even Warren Buffett?
That's not only the idea, but I am confident that that's what has been built by the two of them. And the board understands that its ongoing obligation post-Warren, and let's not get ahead of ourselves, he's not going anywhere soon. I had a wonderful conversation with him yesterday morning, and the enthusiasm, the thinking is still there just like it always was. But I would say that the board has done a very good job in helping to maintain the post-Warren permanence by having Greg Abel as a designated successor.
That was Ron Olson of Munger, Tolles & Olson. George Bernard Shaw advised that those who cannot change their minds cannot change anything. Our leaders typically tend to want to change things without changing their minds, or at least admitting they're changing them, epitomized in the immortal words of Prime Minister Margaret Thatcher.
To those waiting with bated breath for that favorite media catchphrase, the U-turn, I have only one thing to say. U-turn if you want to. The ladies not for turning.
But there are exceptions, as when then Secretary of State Hillary Clinton announced that the United States would make a pivot away from Europe and toward Asia in its policies going forward.
We have reached a pivot point. We now can redirect some of those investments to opportunities and obligations elsewhere. And Asia stands out as a region where opportunities abound.
This week, we've had any number of leaders, political and business, very publicly change their direction, starting with Prime Minister Rishi Sunak, who thought better of his decision to cut short his time at the D-Day commemoration and hurry back to campaign, admitting he'd made a bad mistake. Israeli opposition leader Benny Gantz changed his mind about participating in a wartime cabinet and said that Prime Minister Netanyahu is now, quote, preventing us from advancing to real victory.
What is the actual plan? And that's not clear yet. And that frustration is what led Benny Gantz to decide we can't do this anymore and take his party out.
A lot of European voters apparently changed their minds about where the European Parliament should be headed as they flocked to more conservative opposition parties.
This right-wing surge did actually take place in the two most important countries in Europe, but not across the entire continent.
Which caused French President Macron to shake things up by calling a snap election of his own parliament.
Above all, I hope that on June 30th and July 7th, the French will elect as many MPs as possible from the presidential majority.
But perhaps the biggest about-face we saw this week came from Sherry Redstone, who had been flirting for months with a big deal that would merge Paramount into David Ellison's Skydance. Just as Global Wall Street was getting ready for the big announcement, just as a special committee of her board was getting ready to approve the transaction, Ms. Redstone apparently changed her mind and decided she wanted to stay in the entertainment business her father had founded after all. At least for now.
There's a 50% chance that nothing happens. That in the end, Sherry says, this is too much. I will just keep the company.
This is not the first time Paramount has needed to turn things around. As its own miniseries, The Offer on Paramount Plus recently explained, it was in bad shape in the early 1970s. Now, all Sherry Redstone needs is a godfather.
Paramount is going to come crashing down. We need hits.
You've read The Godfather, right?
Godfather.
Sure, who hasn't?
That does it for this episode of Wall Street Week. I'm David Westin. This is Bloomberg. See you next week.